Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with Tucker Walsh. He's a portfolio manager at Polen Capital, and we'll talk about his specialty, small cap growth stock, something everybody loves to talk about lately. This week in the mailbag, listener Peter W. was not happy with our interview last week, plus questions about gold and drips. In my opening rant, I'll talk about the same thing many people are talking about this week, the fiasco at Archegos Capital Management. That and more right now on the Stansberry Investor Hour. So here's the story. This guy, Bill Hwang, is a former employee of Julian Robertson, the famous hedge fund guy who had a company called Tiger, like Tiger Investment Management, I think it was called. And he was one of the famous, all-time famous hedge fund guys. And I know at one point their strategy was like long the best 200 companies and short the worst 200. And Tiger has sent lots of people out into the world. They're called Tiger. They call them Tiger Cubs when somebody leaves Tiger and then, goes out on their own. And usually Robertson is behind them and he stakes them with some money. And one of these Tiger Cubs is this guy named Bill Hwang. And Bill Hwang left in 2012 because he pleaded guilty to insider trading, basically. In their, they had the Tiger Asia fund that he was in charge of, and he pleaded guilty, and he agreed to just get out of the securities industry for the rest of his life too. But he was back in business really quickly with this firm called Archegos Capital Management because it was just family money. And apparently his family is very wealthy because as of recently, it was thought that they were managing like 10 or 12 billion. However, Archegos wasn't just managing 10 or 12 billion. They were levered up, some estimates as high as 5 times. So like maybe, 40 or 50 billion, something like that. Wow, that's a lot. And what happened recently was you saw 2 of their big positions, ViacomCBS and Discover, like the Discovery Network, Discovery Network, the all those nice sciencey shows on TV. Those 2 stocks, they had gone up like rocket ships. And then last Friday, they were just tanking really hard. Well, Thursday night, Archegos had finally gotten itself in trouble. It was running out of money and it was on the verge of getting margin calls. So they got all their bankers together on a conference call, and they all, according to the press reports, they all agreed to an orderly, wind down of this fund. Of course, then Friday, there's the estimates are different, but let's just say 20 or 30 billion of selling. The banks were selling them out. And so these 2 stocks, Discovery and ViacomCBS, just tanked really hard. And these banks that were lending him money, UBS, Morgan Stanley, Goldman Sachs was in on it. There was a bunch of them. You'd recognize all the names. Nomura was another big one. I think Credit Suisse was another one too. And, Credit Suisse and Nomura, I think, were the hardest hit. They had lent this guy money. And he was using, it's a weird thing because, first of all, they welcomed this guy back into the fold, even though he was barred from the securities industry. They welcomed him back into the fold as a client because, well, he had tons of money and he wanted to borrow tons of money, and that means fees for them, right? And he was apparently using total return swaps to take big positions in these stocks. He was taking big concentrated positions. And the way that works, the total return swap is, let's say I'm Bill Hwang and you're Morgan Stanley or whoever. So I pay you a little regular payment based on something like the LIBOR interest rate or something like that. So I make this regular payment to you. And what you pay, and then from you to me, you pay me a payment based on the total return of the asset, in this case, stocks, right? So, and that goes both ways, right? So when the position is screaming straight up and it's doing really well and it's doubled or tripled or whatever it is, you're paying me a ton of money. And I'm still making you, this little, usually a fixed, it can be a variable payment, but it's an interest rate like payment. So it's pretty small these days, right? And then, when I'm making a ton of money in these stocks, you're making these huge payments to me. Oh, but then they're falling, right? And so it goes the other way. And if you're my bank, you're like, okay, enough of this. You got to put up more money. You get a margin call, right? And the bank says, you got to put up more cash in your account or we're going to sell you out. And, they're selling them out. And one of the articles I read said that, they thought they would have them all sold out in like 20 trading sessions or so, like 4 weeks or something. And I don't know that there's this episode is rich with possibility for us, right? First of all, leverage. I mean, what is it with rich people using leverage? I mean, if you got $10 billion, what the hell do you need to lever up 5 times for? I mean, I understand maybe he got there by leverage, but once you get to 10 billion, you're like, oh, okay, I'm cool. I don't need any more leverage, right? Or you ought to be. And frankly, who wouldn't be there if you had 100 million or a billion or 2 billion or something? Why do you ever need to use leverage like that? It's ridiculous. And he was known as a very aggressive, a smart, aggressive guy. So they knew all about him. They knew that, he was thrown out of securities industry, pled guilty to insider trading, and they were only too happy to welcome him back. So, what does that tell you about investment banks, about all these Wall Street banks, right? They're in it for the money. This is a business and they're in it for the money. And if somebody, can generate fees for a few years, yeah, we'll take the risk. But it's a weird thing because these total return swaps, like nobody knew about this. Some of the articles, like there's an article in Bloomberg about how this guy very quietly and secretly had this $10 billion fortune that people didn't know about because of the total return swaps. Like the asset is on the bank's balance sheet. They own the asset. I just have this swap agreement where I'm getting the return off of it in exchange for making these payments. And apparently, as Warren Buffett taught us in his 2002 letter, there's a whole big thing about derivatives in there that you ought to read. The leverage on these things is crazy. It's inherently crazy. You have to put up very little capital to do these total return swaps. So they're inherently highly, highly levered. And I don't know, it sounds like somebody, putting all their money in naked call options or something, it could just blow up at any minute. I thought we were done with all this. We'll never be done with all this, will we? And, some people are writing about the possibility of a contagion. Justice Little over at TradeStops.com had a piece about, he said, this is like the first popcorn kernel popping, right? And so maybe, more of this is going on and we'll find out about it when they all start blowing up. I don't know if that's true. I don't know if there's necessarily a contagion that's starting, I don't know if this is like, I feel like Bear Stearns really lit the match in the 2008 financial crisis when their hedge funds failed. And, they were all levered up and had mortgage securities. And it was, it was just a sign of the times. Turned out to be, looked like lighting a match to a big pile of dynamite. I don't know if Archegos Capital Management and Bill Hwang are that match for this episode or not, but I know it's typical. It's exactly the kind of stuff. This is like typical sign of the top. We're getting near the end of the cycle. People are starting to blow up. You remember Bernie Madoff, he only turned himself in because, the markets were crashing and he couldn't keep up the facade anymore. So, scandals and blow-ups and things happen a whole lot more at the end of the cycle than they do, in the middle of it. So I think that's probably the big lesson here. Another is, leverage. What the hell are you thinking? Don't use leverage. And there's a lot of, margin on the stock exchange is at a high relative to GDP. So lots of people are using leverage to buy stocks these days. And I think you're crazy to do it. Don't do it. That, most of the time I say I won't give individual advice. I'm giving individual advice. Don't use leverage. It's insane. So this is a story. Just type Archegos Capital, or Bill Hwang, Hwang. Archegos, just like it sounds. It's spelled just like it sounds. Archegos. And there's a million articles about it. It's everywhere, and you should read about it because it's a tale of the time. It's a sign of the time, and it'll teach you. Like you put this episode in your head and you say, okay, and the next time you start to smell something, like the next time you see a stock like, ViacomCBS go ballistic, the charts on that and Discovery and a couple other names the guy was into, Baidu was one of them, Tencent Music Entertainment was another one. When the charts on these big cap stocks go like ballistic like that, start scratching your head and wondering if there is not another Bill Hwang Archegos behind it. And, I've said it again, I'll say it before, ballistic charts do not correct by going sideways. They correct by crashing straight back down. So, be careful out there, I guess, is ultimately it. And also, I'm gonna do my quote of the week now, because it also speaks to hubris, right? This guy was full of hubris. He thought he was going to lever up and make tens of billions more, I guess. And I heard this quote by Christine Lagarde, who's in charge of the European Central Bank now. And she was being asked about investors testing central banks. And she said, she was smiling, but I think she was serious. She kind of had a straight face. She said, they can test us as much as they want. That's the quote of the week, because, oh my God, this woman is actually, she's like daring you. She's daring investors. Go ahead. She's basically saying, we got your back. And in that same interview, she did say, we'll do everything we can. Everything that is required, I think was the phrase she used, meaning everything that's required to prop markets up and keep them from crashing. Plain and simple. They're supporting asset prices. That's what they're doing when they go to work, and they know it. And she just about admitted it. And her predecessor, Mario Draghi, back in 2012, quite a while ago, he said a very similar thing. We'll do whatever it takes, right? Because in the wake of the financial crisis, the growth was just too slow. And he said, we'll do whatever it takes. And what did that get you? Negative interest rates. So they can test us as much as they want. Christine Lagarde, president of the European Central Bank, says. Oy, insanity. All right, let's talk to a sane guy who knows what he's doing. Today's guest is Tucker Walsh from Polen Capital. Let's talk with him right now. Let's do it. Since I've been talking about regulation and policy within this show, I should bring up cryptocurrencies, because that's the polar opposite of organized economics and regulated activity. And the best person to explain what to expect in 2021 in cryptos is Stansberry Research's in-house cryptocurrency expert, Eric Wade. Eric is stepping forward with what could be the biggest money-making prediction this year. Eric was on the show last month teaching us all a lesson in Bitcoin. If you already own Bitcoin and you want to know what to do next, then this crypto event needs to be required viewing. You can get all the details right now at www.stansberrybitcoinevent.com. That's stansberrybitcoinevent.com. Check it out. Today's guest is Tucker Walsh. Tucker Walsh joined Polen Capital in 2017. He is the head of the small company growth team and lead portfolio manager of the firm's U.S. small company growth strategy. Prior to joining Polen Capital, Tucker spent 10 years as CEO and head of portfolio management at Copper Rock Capital Partners and 9 years as Managing Director and Head of Small Cap Growth Team at State Street Research. He's our small cap growth guy. Tucker, welcome to the program.
Thanks for having me, Dan.
So the topic today, small cap growth companies, is one that is, I'm sure, near and dear to our listeners' heart. Anybody can sit here and say, Apple's a great business and Google's a great business, but to find, XYZ small cap company that has a good chance of growing 5 or 10x or something like that is a lot different of a proposition. And it seems that is what you do. I was reading on your website, and you guys are looking for these companies that you think have a great competitive advantage and can just grow and grow and grow. And it seems like growth is the big enchilada for you. Is that right?
Yeah, that's correct. We want the combination of growth and a really solid business model. And so quality plus growth, we think, gets the best opportunities for compounding, the highest percentage chance for compounding. And one thing that is a bit daunting for people that are looking at small cap as an area to invest in is the several thousand companies that are publicly traded. Which ones do you hone in on? And for us, we really go for the best companies in our category. So we concentrate in roughly 30 holdings, Dan, so that what we're doing is really trying to zero in on the companies that are competitively advantaged, as you mentioned, have a repeatable growth process. So it doesn't even have to be fast growth, but it has to be repeatable growth, really solid margin structure and cash generation, a top-notch management team, and the ability to take the cash flow that they generate and reinvest into the business. And we think that creates a flywheel effect. We call it our flywheel for compounding. And all of those elements together create the right environment for compounding, we believe.
So, Tucker, I have to say, a few years back, flywheel was like this really kind of buzzy word in the business and investing communities. Why do you use it? What does it really mean to you?
Well, for us, we like the imagery and sort of the thought process behind the kinetic energy that goes with a flywheel, and the fact that all of the elements I mentioned have to work together. And when they work together, and they're working together at a really solid pace, it does create that kind of energy. And the faster that flywheel spins without interruption, meaning that if the company is able to grow at a reasonably rapid rate, let's say 15 or 20% annually for several years, and have a strong margin structure and cash generation, and the management team does a great job by building great culture and reinvesting in the business, all of those things working together create breakout opportunities, the ability for that company to be a much better performer than the average company.
Right. So you hit on, when you were sort of going down your list there with, margin structure and cash generation and reinvestment, you hit a lot of things that, I have a list of almost those exact same things that we put in every issue of the newsletter that I write. And like, even when we're recommending a company like Costco or something, and it makes me wonder about profitability. How important is profitability to you? Because there are a lot of small companies around that are growing really fast, and they may even have a business model that is considered attractive, but they're just not making any money. How important is profitability?
Yeah, to us, it's very important, but the level of profits is less important than just having cash generation and the ability to reinvest. So just going up a little bit further on the P&L, one of the things that's really important to us is that when a company has a competitive advantage, and namely a very strong customer connection, by having that, if the management team is very skilled, they can, for the best companies, they can price the product really effectively for the actual value add of the product. And that's important because you're getting a gross margin that is a solid gross margin that enables the company to then spend in the operating expenses to then try to generate more business in the future. Whether that's investing in R&D so that there's more product development in the future, or sales and marketing to attract new customers. And so when you have that dynamic and the company is disciplined, and that's one thing that's really important to us. We as investors are very disciplined in the way that we look at things. We want cash generation because that is what makes a business durable over time and also allows for the kind of growth over time without interruption that we look for. But we also look to invest with management teams that are disciplined. And we do listen for that when we talk to management teams or listen on their quarterly conference calls. We want to make sure that they're stressing the fact that they're building for the future, they're long-term in nature, they're trying to grow, but that the P&L is run in a very disciplined fashion.
Okay, I'm stuck back on something you said, which really sounds intriguing. This idea of basically, it sounded like matching the gross margin with the value add of the product or service offered. It sounds like you would have to have a method of measuring the value add independent of the gross margin. And then being able to say, well, this gross margin is too much, too little, just right. Do I have that? Am I thinking about this the right way?
Well, the thing that we try to focus in on is trying to understand the company's gross margin relative to similar peers to see if there is something that's particularly special there. So take, for instance, with brands. Brands are able to price their product at a premium because there is a trust factor with the customer, whether it's a B2B brand or a B2C brand, direct to consumer. And so when that is in place, you're generally going to have a business model that allows for a little bit more capital to be able to reinvest back into growth. It isn't actually very precise for every business. It really depends on each business. But the important part is that the robust margin structure is there because, as you mentioned before, there are a lot of companies out there right now that are losing money, but they're losing money because they can't really get a premium for their product, and at the same time, they're really spending a lot at a very rapid pace to keep up fast growth. And eventually, if they don't produce enough margin, they're going to keep relying on outside capital, and that's just a very difficult way to try to create long-term value creation.
So, Tucker, can you share a name or two with us that that's like a quintessential Polen Capital small cap growth company, that really is a good example of all these elements that you're putting together here?
Sure. Well, I like to, for examples like these, use somewhat household names. Given the fact that we're in small cap, they're not always household names. But in this particular case, Dan, you may have heard of Yeti, which makes the coolers and drinkware, and now they're into other outdoor lifestyle products, including luggage and bags, etc. And Yeti is a great example of meeting all of the elements of the flywheel and actually plays to the issue we were talking about before about pricing. So Yeti started as a brand that was mostly for the fishing community. They made very rugged and what they considered at the time to be the best cooler out there. And they created a following that then they were able to take that and create more of a lifestyle and outdoors brand that migrated to drinkware. So many people are aware and use their tumblers, which are much better than all of the other knockoffs that are there. So people do want to pay a premium for those and be photographed with them on Instagram, etc. And they've built a tremendous brand that is that competitive advantage. That's the customer connection. They have a repeatable sales process because they expand their product line very intentionally. They use data from the sales that they make. They understand their customers very well. And so they're able to get repeat purchases and also attract new customers without doing a lot of advertising. The brand itself actually brings customers to them. They have a strong margin structure because with the coolers and the drinkware, so when you go on the site, you'll see that their products are priced at a premium, but they also get outstanding reviews. So if you look at their site on Amazon, you'll see that they get very, very high reviews. And people are very enthusiastic about what they're getting for the price. That creates a really solid margin structure. They generate a nice amount of cash, and then they're able to reinvest that back. And one of the things that we've seen in the pandemic, so a lot of companies have been forced to modify their businesses or pivot in different directions due to some demand destruction. And in Yeti's case, they started the pandemic at about a quarter of their business or so being direct to consumer, and the rest going through channels like sporting goods manufacturers or a newer relationship with Lowe's, to now close to 60% being direct to consumer, which includes the Amazon site, but most of their direct to consumer now is coming from the Yeti.com site. And just the investments that they had made in the years prior to that. So that's why we really focus in on quality of the management team, agility of the organization, the culture that's involved, but also that reinvestment piece. Where are they spending? What are they trying to do? And so in Yeti's case, they've spent money on trying to make sure that they were able to pivot in a situation like what happened with COVID, not knowing that COVID would happen. And so they had no interruption to their business. And in fact, we think that the company is even stronger now, and it positions them well to expand internationally, be more of a global brand and beyond. And so that's where we think that flywheel works when working in unison, really creates this strength of the company that can that can really add a lot of intrinsic value over a number of years.
Tucker, as you've been talking, I went on to Yeti website. I have to say, if I were in your shoes and I were in the meeting and I was getting pitches from analysts and somebody came at me with this, I would just look at all these products, tumblers and bottles and mugs and jugs and barware and coolers, and I would think, I can get this stuff anywhere. That would be my first knee-jerk reaction. What would you tell me?
Well, I think we struggled with that a little bit at the beginning too, Dan. We wanted to understand better what was behind some of the numbers. So Yeti showed up on a quantitative screen that we have that looks for the things that I was mentioning before. So we like to see consistency in the growth, but we also like to see a strong margin structure, returns on capital or strong incremental returns on capital. Sometimes that'll come in the form of cash flow return on invested capital, so that there may be parts of the P&L where it may not show the strength of the business due to the accounting, but if you are able to understand what's happening with the cash flow, that will tell you a lot. And in this particular case, Yeti scored very highly on both growth and cash flow return on invested capital. And so that we figured there had to be something there. We needed to understand it better. As a team, we've spent a lot of time over the last several years trying to get a better handle on the proliferation of smaller brands in the digital age and the ability for companies that didn't have what would be considered to be sort of an 80s or 90s moat in the form of brands, which used to be you had a brand, you had shelf space in the front of the store, and then you'd have excess cash to reinvest in advertising, so you'd really just be blitzing the customer with that. Well, now in the digital age, it's much more dispersed, where smaller brands can get broader reach. They can have a direct line to the customer. And we believe that this has opened up a lot of opportunities for companies like Yeti, where, as you said, yes, there are others that make knockoffs, but there's a significant set of customers that want high quality, are willing to pay up. There's also a status issue with better brands too. So just like people want to be photographed with a Starbucks cup, they also want to be photographed sitting on top of a Yeti cooler with their dog. And so that actually creates that brand value, but it doesn't have to be for everyone in order for it to be a great investment. And that's what we felt like we learned when we spent some time really trying to understand what is the brand about, who are they trying to connect with, and do we believe there's a long runway for not only the products we see today, but other products they can introduce in the product line in the future.
Yeah, that would be another question. Like, how far can we go with this? What are we doing? What could they do that they're not doing now? That would definitely be a question, on my mind. But one thing I noticed, I'm looking at just like a Yahoo quote here, and it says the market cap is about 6.3 billion, which makes me wonder how small is small. What's our universe for your small cap, growth strategy?
Yeah, so we want to make investments generally below 3 or 4 billion, 3 or 4 billion type of range and below at initial investment. We believe that gives the best opportunity for the small cap category. You get two things we believe down in the smaller end of the spectrum. One is potentially a longer runway for faster growth. So the companies that we're generally looking at aren't going to run into the law of large numbers for quite a few years. That's number one. Number two is that you get a little more inefficiency down in that area. So that's where we like to make investments. But when we make investments, we have a long-term horizon, and we think that's a significant strategic advantage for us and a competitive advantage for us. That's been part and parcel of the Polen philosophy going back 30 years for the large cap strategy. And in doing so, what we're doing is finding a company, a business, a management team that we want to put money to work with, think like owners, have a long-term horizon, and let them do all the hard work. So then when we make an investment down there, the goal is to have it compound such that it gets to be a market cap that's of a size that will be lifting our weighted average market cap. So we'll manage that statistic, the weighted average market cap, to provide that small cap exposure. And when a company gets up into the 8 to 12 billion range, we'll start to make some trims and eventually move it out of the portfolio and reinvest it back into something under 3 or 4 billion.
I see. And I'm sorry, is it possible for a stock to be too small for you?
Generally, we don't make any initial purchases under 500 million, Dan. A lot of that has to do with the fact that the companies at that market cap are generally not going to have enough of the elements or all the elements of our flywheel. So we are very disciplined. As I mentioned before, we only own roughly 30 holdings. So we're very picky. There's a very high hurdle to get in. And companies with market capitalizations of 400 or 500 million generally don't have that kind of characteristic. We wouldn't say that it'll never happen, but it generally does not happen. So our range at initial purchase that we tell everyone is about 500 million to that 3 or 4 billion.
Okay. It's interesting, isn't it? It's a small cap strategy, but a business just has to be big enough to perform a certain way, doesn't it?
Oh, we believe so. Absolutely. And there's a lot of talk right now about disruptive innovation, disruption. And in the small cap category, we think by definition, you're always investing in disruption. So I've been doing analysis and portfolio management in the small cap category for 30 years now. And that's all I've really known in looking at small cap companies. They're trying to disrupt the status quo. They're trying to find a new way to deliver more or better value, more convenience to customers. And so, but one of the things that's also important is that there is discipline involved. And in those 30 years, I've seen different capital cycles, and the companies that have the combination both of really strong product and a strong management team and a strong organization plus financial discipline are the ones that end up being the ones you look back and say, oh, that was 2 billion market cap, now it's 25. And you say, okay, so the folks that were talking about this strategy, they pulled it off. They were able to do that. And not everyone can do it, obviously. So that's really important, is having a sort of, as you said, get to that size where then that next stage of the company's growth can deliver the kind of compounding we're looking for.
Okay, so you're looking for, I'm just reading off your website here. It says, we believe superior earnings stability is the word you use, and financial strength serve as a margin of safety that typically results in less volatility during declining markets. There's 3 or 4 questions in there for me, but the first one is less volatility in declining markets from small caps. That's a tall order, isn't it?
Well, I guess we would give the caveat that it would be less volatility within the small cap category. And we do feel strongly that is true. And so one of the purposes of having an allocation to small cap, we believe, is that you're investing in the future. You're investing in the next set of large cap companies. They do come from the small cap area, but not all of them make it there. So we do think that having the kind of the strength in the business model that I was discussing before is really the number one element to being able to be strong for many years, and so that we can sleep at night thinking like owners and owning a position in the company. And so what typically happens in a very challenging economic environment or in a challenging market environment is that companies that are a little bit further out on the risk spectrum, meaning they are growing very rapidly but need outside capital, those are stocks and companies that are at a lot greater risk when things don't go in a straight line. And that's why it's important to us to have that cash generation. What we've seen in the pandemic, so the first thing that a lot of companies did, all the well-run companies that we own, the first thing that they did was make sure that everything was really solid with their balance sheet, and make sure that if they felt like they were going to be really strongly impacted, that they were able to withstand that demand shock. And not all companies can do that. And in past downturns, the companies that were a little bit further out on that risk spectrum and the ones that were really dependent on capital from the outside were the ones that had the most trouble, and the stocks were the worst performers.
Yeah, so much of what you say, and of the stuff written on your website, it just reminds me of Warren Buffett. It's as though instead of having hundreds of billions at his disposal, he had hundreds of millions to manage. And I feel like he'd do and say everything you're doing and saying.
Yeah, we obviously admire Warren Buffett and believe that the quality of the companies is very important to having great investment returns. We also like to see companies that are trying to move forward and trying to grow, but do it in a way that is very disciplined and also brings forward a lot of the things that are necessary to building long-term intrinsic value, right? So a company is doing this today, this is what you see. And so let's go back to Yeti, for example. They did coolers, and then they did tumblers, and now they're doing other areas like bags and luggage, etc. But pretty much any sort of rugged outdoor type product is available for them to introduce with the strength of their brand over time. But they do such an exceptional job of executing on what we see today. But in 5 years and 10 years, it won't be what we see today. They will have evolved and built on top of what they have today. And we think that's really key to creating great long-term value, both in the company and in the stock price performance.
Okay, I'm going to zero back in on that one paragraph I read. The idea of earnings stability and financial strength serving as a margin. I get financial strength serving as a margin of safety. But earnings stability is tougher because from the point of view of a capital allocator, it's stable up until right now, let's just say, but then you're committing capital and it better darn well be stable next year and next decade if you wind up holding the thing a good long time. How do you get that kind of conviction? Does it come right away when you make the initial allocation, or do you build it over time and build a position over time and get higher conviction? And then, okay, we really do have a margin of safety and earning stability here.
Well, for us, since we only own roughly 30 companies, we take our time. We are very deliberate in our investigation of the company. So we build conviction through our team-based approach. And so we have a team of 7 individuals, and we work together in teams of 2 when we do an extensive deep dive into a company that we're very interested in. And 2 people on our team make the affirmative case, the investment case, and 2 people will make the counter case or look for places that the flywheel can get interrupted. And we do that because we want to work well as a team and eliminate as many biases as we can. So we also think that it's very hard for the human brain to have both the positive and the negative case held at the same time and be completely objective about either one. So when we work together as a team, we reduce blind spots, and then we also really try to just develop an understanding of what the company's trying to do, where they're trying to go, how it will get there, and we'll even, at the tail end of our process, do what is called a pre-mortem. And so in the healthcare profession, after a patient dies, they'll do what's called a post-mortem, figuring out what happened. And so what we do is we do an exercise where we say, okay, this investment was a bad investment for us. Why was that? And when there was a demand shock, what happened to the business model? And Dan, that's how we build conviction in the possible outcomes that can happen in the future, because we can't predict the future. Even the companies can't predict the future. But if we can say with some certainty that if something went wrong, this company has a lot of has a margin of safety built in the way the business is managed, in the way that they can get access to capital if needed, and also that they can weather that sort of downturn. Those are the things that can give us the longer term conviction.
Okay, I like the topic of conviction because I think it's really important to our listeners, because professionals can have conviction, but the individual investors who make up the bulk of our audience, I'm certain that they're challenged by conviction, especially during times like we experienced roughly 1 year ago, which leads to my next thing that I'm really curious about here. What did you guys do in the first quarter, especially in March of last year? How did you behave? What were you working 7 days a week, 15 hours a day all of a sudden? And what were you doing at that time?
Well, after a brief, I guess I would call it acclimation period to everyone working remotely. So at the same time that the markets were very volatile, we were all getting used to working from home full time and being isolated at home. And so actually, that was a pretty significant adjustment in and of itself. But in terms, and we actually did, I'll give my team a tremendous amount of credit for how well everyone adjusted and really stayed very positive in the face of what was a very uncertain period. But from a business perspective, in looking at the companies, our holdings, and trying to figure out what's going to happen here, is we really went back to the basic principles that I just mentioned. is to just look at the business model and say, if we did a demand destruction analysis and we said, if this happened, what would happen with the company and its ability to have enough capital to continue to grow? Well, I mean, we don't worry about ours surviving because we've already invested in companies with a margin of safety, with a great business model. But there are some companies that, due to what happened in the pandemic, where their demand destruction was severe enough that you had to worry about whether or not they could compound value. Would people return to being in a physical location is one example. And we did make some adjustments in the portfolio because we were concerned that there was enough of a dislocation that it would last a while. But at the same time, we were finding opportunities where there were companies that were higher market cap than our cutoff, but let's say they were at 6 or 8 billion and they had come down to that 3 to 4 billion range. One great example of that is Etsy, which we really didn't have an opportunity to buy in our small cap product until the sell-off in the pandemic. So we took the opportunity with sales we made where we felt like some of the businesses would be impaired for some time, and bought a position in a company like Etsy where we thought that the outlook was very strong and a lot of upside, and it turned out that that was a good move for the portfolio. One other thing I'll mention is that we actually launched our small to mid cap product in the throes of the sell-off of the pandemic, April 1st. And so we were thinking offensively, especially for the companies that had been sold off rather hard. So anyway, that's the combination of what we were looking at that time.
Wow. You bought Etsy during the pandemic bear market. Nice move. I mean, at the bottom, it was like below 40 and now it's 200. So I'm guessing your strategy has done extraordinarily well over the past year, because I know that's not the only name that has performed like that.
Yeah, well, they did a lot of the hard work. They did a fantastic job of pivoting the business. This is actually, Etsy is a really great example of how a well-run organization, a well-run company with a great culture, and actually passionate customers, and in this case, it's a two-way market. So they have passionate sellers on the platform too. They actually made a plea to their sellers for those that could manufacture masks to please do so and sell them on the Etsy website, so that it would take some of the strain off of the demand for medical masks to keep to have enough of a supply for the healthcare workers. And it was a really just a great thing that they did in general, but the sellers really rose to the occasion. And so a lot of new customers flocked to the Etsy site, and it created obviously a swell in demand for masks. But the follow-on effect 1 year later now is that the non-mask traffic for Etsy is up 90%. So that kind of it was a terrific, just a great cultural move for the company to do that. But also it's going to have a lot of great residual benefits for them in the future. And that really is a testament to how great the management team is.
Yeah, that's a very cool story. So I have to ask, I'm a value guy and all the listeners know it, but valuation it's a different animal when you get down to these smaller, faster growing companies, isn't it? How do you think about it much? And if so, what's the key insight that you might have for us about the way you think about valuation?
Sure. So we look at valuation last in our process. We do evaluate valuation. One of the reasons that we do that for our style is that we want to make sure that we are doing a really thorough job of understanding the company, understanding how and if it can compound over a number of years. If it can do that, the precision on valuation becomes much less important for the outcome of the stock compounding. We believe this because if you get a business that is really well connected with a customer, that has a robust business model, strong management team that can reinvest and do things with that model and get into adjacencies in areas that you can't see today, that is generally what provides the serious outsized return. We do it in a way that we think is very disciplined, so we like to refer to how we do it as investing in disruption with a lot of discipline. And so when we find those, what we want to do, if it fits all of the elements of the flywheel, we just want to make sure that the valuation isn't completely way off the grid. The level of precision, as I mentioned, is not as important, meaning that if the company several years out can be 2 to 5 times the size, and the valuation is in line with the peer group, and also at a potential has a free cash flow yield several years out in the future that we think is reasonable from that standpoint, then really time and patience is your friend, because the companies generally can do a lot better with those elements that I just mentioned.
Okay, so as we pointed out, the markets have just screamed for a year here, and you've given us a couple of good examples with Yeti and Etsy and stuff, and it makes me wonder, as we get close to finishing up here, is there anything that you find really attractive right now that you've recently initiated that you think is still really quite viable today?
Well, yes, we actually think that everything that we own today is viable.
Really?
We actually think that all of the companies that we own are undervalued as you look out over the next few years. We're not surprised by price volatility. In fact, it's one of the things that is something that we're used to in the small cap category. But because we take a long-term horizon, the compounding happens over that period, but it's not in a straight line. The companies themselves are less volatile than the stock prices. And so when you do get a strong run-up like we had last year, there could be some volatility in the next 3 to 12 months. That volatility doesn't necessarily have to be down. But what we're looking at is if the stock has appreciated, well, what's happening with the business? And if the business has gotten a lot better, oftentimes it really justifies the stock price. Etsy and Yeti are 2 great examples of that, where the companies really executed well in the pandemic. They were already terrific companies before the pandemic, and they were well positioned to be able to weather a demand shock. And what they did was they pivoted and created a stronger company that will be a strong growth companies, we believe, for several years to come. And so the price appreciation, we think, is well justified, and they're well set up, we think, to be great investments as we move forward. And that's why we run a concentrated portfolio. We only want to be involved in the companies that we have that kind of conviction in.
Sounds good to me, man. All right, we've actually been talking for a while now. I do have one more question for you. It's my final question that I ask all my guests. Exact same question. If you could leave our listener with a single thought today, what would it be?
I like to use the phrase that has been used by many long-term investors, which is, time is your friend. So time in the market is key, not timing the market.
Oh, I like that. I like that a lot. Yeah, straight to the point too. And it's true. You're not going to pick the bottoms or the tops, right? You're just not going to do it. So it's far better to just stay in. And we told the story recently on the program of the coffee can portfolio. I imagine that one's near and dear to your heart.
Yes.
All right. Wow. This has been, I feel like the time has raced by here.
Yes.
So we're definitely going to invite you back, I think, is the answer to that.
Okay, great. Thank you, Dan. Really appreciate it. Thanks for having me on. It was a great conversation. Really appreciate all the questions and for having me do the podcast. Definitely would look forward to doing it again.
Okay. Bye-bye. Well, I like this small cap growth thing that we're on. We've had a couple folks recently, Tucker's one of them, where we're talking about, just a bunch of different stocks that are not, it's not Facebook and Google and Apple, for God's sake, or Tesla, or something that everybody talks about all the time. And I'll tell you something, when I asked him what we could buy now, what's undervalued now, and he said everything, I was sitting here going, really? Wow. And he said it with a straight face and lots of conviction, it sounded like to me. So, that speaks to a real long-term, serious, high conviction kind of a strategy. And, you can go knock around. I was knocking around on their website, Polen Capital, Polen capital.com. And there's lots of good stuff on there. So maybe check it out. All right. That was cool. Let's do the mailbag. Let's do it right now. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. You can also give us a call at our listener feedback line. That's 800-381-2357, 800-381-2357. Tell us what's on your mind. Got some good stuff this week. The first one is from Johnny L. And he says, hello, Dan. Thank you for the podcast. The diverse ideas and guests you bring each week stimulate thoughts and perspectives that I may not otherwise have considered. As I listened to Per, that's Per Byland, last week's guest, as I listened to Per discuss regulations in episode 117, he said 117. It was actually 199. I couldn't help think about how similar regulations are to a surgeon's scalpel. They could be either good or bad depending on the hand that holds it. In the hand of a skilled and disciplined surgeon, the scalpel might only be used in those rare times needed to remove a cancerous tumor, one that would otherwise kill us. The problem is that instead of electing skilled surgeons, we the people tend to elect the plastic surgeons who tell us that everything that makes us who we are is ugly and should be removed. Before we know it, they have used the scalpel to make millions of incisions, removing every wart, mole, and beauty mark. The result is a slow death bleeding out from those millions of cuts. Johnny L. Thanks for the email, Johnny L. I see the point you're making, but I believe that what you're pointing out here is the reason why most regulations just aren't going to work. I feel like what you're saying is human nature just doesn't do this regulator thing very well at all, right? Human nature, in the case of Bernie Madoff, was, they took the evidence to the SEC 10 times or whatever it was. It was like 8 or 10 times over roughly a decade that Harry Markopolos took the evidence to the SEC and said, there's fraud here, there's fraud here, there's fraud here, 8 or 10 times. And, human nature was, Madoff, God, he's such a bigwig. Oh, boy, we don't, we're going to look the other way. We can't get him in trouble. This can't be right. It just, that's the problem. The problem is once you initiate the regulation, it's guaranteed to be, to have bad surgeons. And, using your little analogy, your story here, you're guaranteed everybody who tries to use the thing is going to be a bad surgeon. And if it requires all that skill, it's sort of, you want to think of this the way Peter Lynch talked about investing. You want to invest in a business that a monkey could run because sooner or later one will, But I see where you're headed, and I think I think you're making an actually very good point. Thank you for that. Next is Alex W., and he says, Dan, I just finished the Annie Duke episode. That's episode 181, November 19th, 2020. He continues, and ordered 2 of her books on Amazon.com. Thank you for interviewing her. At the end of that episode, there was a letter that asked about DRIPs, dividend reinvestment plans. I think you misunderstood the question. I'm going to rephrase the question so you have a fair shot at answering it in a meaningful way. And then he says, if the main benefit to DRIPs in the past was that I was getting fractional ownership of shares without paying commission, and now I can buy fractional shares without commission any old time I want with, for example, Robinhood, is there still a benefit to being in the DRIP program for my long-term stocks? To which you might say, yes, one possible benefit is dollar cost averaging, and another would not be not spending the dividend on something else, as well as the benefit of not allowing it to lay fallow in your account. Keep up the good work, Alex W. Thanks, Alex. You're right. Yeah. If that is the question as you framed it, then I would say that just being on automatic pilot in a good business where you're reinvesting the dividends is absolutely the best way to compound, right? You want to reinvest in a good business. You want to keep your capital in there. So when they take it out and they issue this dividend, you put it right back in so that they can continue doing good things with your money and compounding at high rates over a long period of time. I like the automatic pilot feature too, just because, if the cash piles up in your account, what cash does, it burns a hole in your pocket. You're liable to do something foolish with it. And if you just always reinvest the dividends in your best stocks, then, it kind of keeps you out of trouble and keeps you headed in the right direction. But thank you for the clarification. I appreciate it. Next is John A. And John is worried about being too paranoid. He says, hi, Dan, there has been a lot of talk about the government confiscating physical gold if the stuff hits the fan, so to speak. I don't really want to think that they would do it, but since they have already done it before, I want to be wise in considering it. The Sprott Physical Gold Trust seems like a reasonable alternative way to own physical gold, but what would happen if the U.S. government started confiscating physical gold? Sprott says the gold is stored in the Royal Canadian Mint. Is that owned by the Canadian government? Will there be a cooperation between the U.S. and Canadian governments to hand it over? Would the U.S. government halt the trading of the Sprott, the ticker symbol's PHYS, PHYS? The Sprott Gold Trust, like they did Xiaomi, was a Chinese stock that got halted apparently in his account. And then he finally says, or am I just being drawn into the conspiracy world? Ever forward, John A. I don't think you're just being drawn into the conspiracy world. And hey, powerful people in politics and business and everywhere else conspire to do things, don't they? I don't think you're being crazy in considering this. And to consider, yes, would the U.S. get the cooperation of the Royal Canadian Mint? They might do just that. I think the key to having gold out of the reach of governments is having it in more than one place. I don't want to offer any advice, but I'll just leave it there for you. And it's an excellent question, and you're not just being paranoid, you're being smart. Finally, this week, we have Peter W., who was not really happy with our interview with Per Byland last week. Per is an economist, and we talked about regulation and all the damage that regulation does to an economy. And Peter W. has a problem with that. He says, Dear Dan, I don't know how a discussion on regulation cannot include a discussion of externalities, but your guest seems to have managed it. He provided the counterfactual arguments for the case of overregulation, but failed to consider the counterfactuals of underregulation. As an example, regulation is necessary where the market does not properly price the cost of externalities. Examples from the past include the industries that dumped waste into the Cuyahoga River to the point of it catching on fire, or the Ethel Corporation that promoted the use of lead additives in motor fuel to the detriment of residents living close to motorways. Both of these are examples of market failure, and any discussion on the usefulness of regulation must include a discussion of externalities and market failure. And then he said, I brought up the issue, but failed to pursue it. Then he moved on to another topic of minimum wage. And he said a lot of things. He said, your guest also seems to have missed the value of the minimum wage. The limiting case of no minimum wage is when labor is free. Arguably, free labor in the form of slavery was a major reason why the Confederate States did not industrialize at the same rate as the North. So consider had agricultural labor, but I don't want to read all this. It goes through all this stuff about slave labor. Without a market for labor-saving innovation, where would our civilization be now? So absent a minimum wage, economic output per unit of labor will be reduced. This is all nonsense. So Peter, on the subject of minimum wage, slavery is kidnapping. It's illegal. It's done in the world. It has always been done. It probably always will be. But in the United States, at least, and in most civilized countries, it's illegal, right? The world is up in arms at the, I believe it's pronounced Uyghur, slaves being used in China, as well as they ought to be. And frankly, I think we're tolerating it too much. We should be all over China about this. You know, it's kidnapping. You're saying that you own human beings. So the whole thing about, minimum wage and slavery is silly. I'm sorry, it's just wrong. Kidnapping and minimum wage don't have anything to do with one another. And then you say the argument that a low minimum wage will increase employment is akin to the increased unemployment, I think you meant, is akin to the broken window fallacy that your guest cited. In both cases, the resulting activity results only in marginal economic gain compared to that. I'm not sure the point you were trying to make here. You lost me. You said a large proportion of the population will be employed in occupations that provide only marginal added value without a minimum wage. If a large proportion of the population only add marginal economic value on average, we will all be poor as a result. This is just dumb. Wages are an expense, Peter. They're an expense. If you pay too much for it, you will demand less of it. Period. You're overthinking this. You sound like an academic. I hope you're not, because we don't need more academics with this nonsense. But you're just dead flat wrong about minimum wage. As far as the other things, a lot of those failures aren't market failures at all. They're failures the failures to establish private property. We pollute the hell out of things that are commons, right? It's the tragedy of the commons, because we say, oh, everybody owns it. The government won't let someone own it. So everybody owns it. So it gets polluted. That's a huge, when it comes to dumping waste in places, that's a much bigger problem than anything else, is that there's no private property there, right? So if we focus much more on letting people own things and giving them an incentive to keep them up, then, we would not have some of these problems that you're saying are a failure of the market and a failure of too little regulation. Most of the time, the failure is of too much, and it's a failure of the government not allowing the market to work. And I'm not saying it's 100% of the time. I'm not saying you don't have somewhat of a point. Let's face it, like air pollution, I mean, that's a tough one, right? What am I going to do? Own the air? I'm allowed to pollute the air over my factory, but no other air? That just doesn't work. It's not feasible. And you have to say, look, you're polluting air. You're going to kill somebody. Cut it out. You just have to. There's no other way around that. There's no demand for more polluted air. And polluted air is a bad thing. We've all been to I don't know if we've all been to them, but we've at least heard about, these cities where they're just doing something like, they're burning a lot of coal or something else, and it's just fouling up the air horribly, and you can hardly breathe, and it's really bad for you. And that's no good. I agree. That's, human beings shouldn't choose to live in places like that, but sometimes they feel like they have no choice, I guess. And that's the other thing. Look, if everybody chooses to be there and they don't want to go, somewhere else where the air's cleaner, none of this stuff is a slam dunk. No regulation is a slam dunk. But a lot of regulation is really, really bad and it mostly makes life harder for newer participants, for newer competition. It's mostly used to tamp down competition. And people who say otherwise are just fantasizing, you know? Anyway, I shot this email. I shot your question back to Per Byland. So if he gets back to me with a response, maybe we'll read it next week. But thank you, Peter. These are valid questions. I just feel passionately that you're wrong. Okay, that's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. Listen, if you like this episode and you really enjoyed it and you want to tell the world about it, please do. Send somebody a link to the podcast so that we can continue to grow. Anybody you know who might also enjoy the show, just tell them to check it out either on their podcast app or at investorhour.com. And I thank you for doing it. Also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. You can follow us on Facebook and Instagram. Our handle is @InvestorHour. You can follow us on Twitter. Our handle there is @investor_hour. If you have a guest you want me to interview, drop me a note at feedback@investorhour.com or give us a call at our new listener feedback line, 800-381-2357, 800-381-2357, and tell us what's on your mind. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.